Good day, this is Richard Evans from Revenue Report Card, here to review the final product sent to our clients on a monthly and annual basis, and that enables them to assess the effectiveness of their channel utilization. Revenue Report Card adds value to your financial statement presentation. No longer will the gross reservations revenue, as we can see here on the three financial statements representing a cruise line, car rental, or hotel, and perhaps one of the most important on the financial statement, be underanalyzed and presented without valuable insight. As we know, often the battle for profitability can be won or lost on that top line. Whether in hotels, car rentals, cruise ships, or airlines, the Revenue Report Card shows the breakdown and mix of what we're doing and how effectively we're optimizing. Our revenue managers and or specialized revenue programs are the maestros in this complex game of channel management and optimization. And the report card can help everyone better understand profitability and the cause and actions behind the scenes. We all assume that the revenue programs some of us purchase are the answer to optimization. And indeed they should be. But have they been put to the test? Are we in fact optimizing more effectively than our neighbor or comp set? And are we using these programs correctly? All those are questions that can be answered through the report card. The end result is the report card itself, and that can be seen on the screen. You can see by the blue arrows that we assign a number grade and a letter grade to our client, which in this case is Hotel B, and we come up for a number for the comp set. But please remember that these grades alone, on a channel-by-channel basis, are not indicative of excellence through a grade of A or failure through a grade of F. On a channel-by-channel basis, it rather measures the spread in each channel between what the consumer is willing to pay against the profitability of each channel. It is not until the final summation and grade received on this report that this letter grade becomes an indication of excellence or substandard of performance. In effect, it is the final mix that creates a full view of whether we or the software we use has performed effectively, efficiently, and profitably. We all scientifically incorporate a blend of channels to enhance our revenues. This is broken down into two categories, as we can see here on the Excel worksheet. The first category is here, and the second here. So the first cost is between what the consumer is willing to pay and what the client actually deposits into the bank. The second series of costs are between what we deposit into the bank and what the channel profitability is after we deduct direct payroll, benefits, search engine optimization, website costs, travel ads, keywords, print ads, GDS placement cost, and so on and so forth. And remember, every client invests different amounts in each channel, has negotiated different rates with each vendor, and chooses to devote different amounts of time in pushing business through those channels. So, in effect, no two client scores are the same grade in any given channel analysis. So let's look at the components of the report card. This is a side-by-side gross room revenue statement where we compare Hotel A, Hotel B, and Hotel C. In the first column in each, you can see a mix of segments from which reservations are booked. Total reservations, total gross room reservations are $10 million in each of the hotels. Now, in the prior screencasts, I had mentioned that in this set of hotels that we have used, that Hotel B is the most optimally run of the three hotels, and so keep that in mind. Let's go to Hotel A, and we can see that in Hotel A, they have booked 16% and 20%, or 36% of all their business through their OTA channel and their wholesale channel. Now, those are costly channels. Hotel B has booked 30, 5%, and 15% through their hotel website, their PBX operators, and their repeat guests. Those are some of the lower cost channels. And finally, Hotel C has booked 40 and 30% through their OTA and their wholesale receptive operator, FIT, vendors, for a total of 70% of all gross room revenues. Believe it or not, this is a scenario we see more frequently than you'd expect. It's an easier option for the sales department and, of course, brings in a high occupancy percentage. So the hotel always is busy. The problem is that often it can be devastating to the client's bottom line. So in comparing Hotel A to Hotel B, the difference between what is deposited into the bank for B and A is $628,000, and the difference between what is deposited in the bank between Hotel C and B is $1,117,000. Not an insignificant amount of money. Let's now move to our algorithm calculations. You can see the algorithm is represented by this black area. And very simply put, in each of the hotels, for the second set of costs, the most efficiently run hotel, Hotel B, has $200,209 of additional cost, A, $247,964, and C, $249,612. We're going to compare A and C to our most optimally run hotel, B. And so let's make the difference between 247 and 2 is 47,000, shown here. The difference between 249,612 and 200,209 is 49,403. And then if you remember from the last page, the cash difference in the bank is 628 and $1,117,000. So you're seeing a large benefit. Hotel A is leaving $675,754 on the table compared to B, or a total of $24.68 per occupied room. And Hotel C compared to B is leaving $1,166,403 on the table, or a total of $39.80.